My name is Edward Binns. I'm a retired certified public accountant. I worked for nearly a dozen years in the nonprofit industry, especially in financial statement preparation, working with the auditors annually, and on the annual nonprofit tax return, the information 990 return prepared each year for the IRS. At the beginning of my career, I worked as a field auditor for the Commonwealth of Virginia, Auditor of Public Accounts, where we audited counties, courts, and independent state agencies. My last job before retiring was with the state internal auditor in Richmond, Virginia, working on the state's fraud, waste, and abuse hotline, where I took the information and performed investigations. In other words, my last job was as a state fraud examiner. There is a great financial feeling of uncertainty and disquiet in the world, which we are calling the financial crisis. The purpose of my talk here today in Hot Springs, South Dakota, where I've retired, is to discuss what I call the derivatives crisis, because I believe this financial crisis is fundamentally the result of the large derivatives position of the world's financial institutions. This is the result of what, in accounting terms, is called a desk audit. In a desk audit, we don't audit our own desk or take pictures of it or determine its value. We sit at our desk without actually going anywhere or seeing anyone and try to form an opinion or a likely series of events involved with a remote situation. We audit from our desk. And the result of my desk audit on the worldwide financial crisis is that it is a derivatives crisis. And I will try to explain this over the next 75 minutes or so. What is a derivative? Well, there's a group called the Derivative Study Center at the Financial Policy Forum at 1660 L Street in Washington, D.C. They have a description of derivatives on the internet that I'd like to read briefly. Derivatives are financial contracts designed to create pure price exposure to an underlying commodity, asset, rate, index, or event. In general, they do not involve the exchange or transfer of principal or title. Rather, their purpose is to capture, in the form of price changes, some underlying price change or event. The term derivative refers to how the price of these contracts is derived from the price of some underlying security or commodity or from some index, interest rate, or exchange rate. Examples of derivatives include futures, forwards, options, and swaps, and these can be combined with each other or traditional securities and loans in order to create hybrid instruments. Derivatives play an important and useful role in hedging and managing risk, but they also pose several dangers to the stability of financial markets and to overall economy. Derivatives can also be used for unproductive purposes, such as the avoidance of taxation, the outflanking of prudential regulation of financial markets, and the manipulation of accounting rules, credit ratings, and financial reports. An example of this misuse of derivative is to use it to move corporate income from one reporting period to another, or from one tax period to another, or to disguise an illiquid position by creating supposedly independent entities which aren't independent but have a lot of debt. And that is what Enron did, why it went broke, and why, when it went broke, the accounting firm that performed the audit, Arthur Andersen, that accepted these entities also disbanded and went broke. So there's derivatives and there's misuse of derivatives. I would like, for the purposes of today's discussion and the desk audit, to split derivatives into two pieces. One of them is derivatives traded on an open commodities exchange where there are dealers, there are reserve requirements, and there's something behind the derivatives. On the other side of this derivative, there really is some sugar being stored in a warehouse, or cotton, or silver, or coffee, or any of the things that are traded on the commodity futures board. This also is subject to its own federal entity that supervises and regulates those derivatives. In that world of traded commodities, you have derivatives that are supported by a real situation or a real event or a real amount of some commodity. And they are unlikely to go to zero in value. But our description of derivatives, which I just read, notes that they can be qualities, they can be interest rates, they can be events, they can be temperatures. These derivatives can go to $0 in value, and that is going to become very important as we go through this. The discussion of the financial crisis that we have heard through the media generally has talked about it in a certain way and is certain key events. And I'd like to summarize this for you by giving you the standard explanation for the financial crisis. And I'm going to use a business and policy study at the Brookings Institution, which called The Origins of the Financial Crisis by Martin Neal Bailey, Robert E. Lighton, and Matthew S. Johnson. And I'm going to read the chapter headings here with some comments because I think you'll be pretty familiar with this as a result of the news coverage over the last 18 months. Housing demand and the perception of low risk in housing investment. Houses have always gone up in value. Most of the mortgages are bundled by federal agencies and have an implicit guarantee behind them, and therefore they're regarded as a safe investment and therefore a safe foundation for derivatives. They can be bundled and the derivatives can be bundled. The shifting composition of mortgage lending and the erosion of lending standards. The mortgage lending went to more and more, a higher and higher percentage of borrowers who were basically unstable or first-time borrowers borrowing on a large mortgage. And the erosion of the lending standards came from less integrity by the people involved in the process, the people selling, the brokerage, home brokerage firms, and even a reduction in the integrity of the bankers involved. Third, economic incentives in the housing and mortgage origination markets. Fourth, securitization and the funding of the housing boom. Securitization meaning the bundling that I've been talking about, and also the existence of large amounts of derivatives based on those bundles. Then came more securitization and more leverage, CDOs, SIVs, and short-term borrowing. Then credit insurance and tremendous growth in credit default swaps. Credit default swaps are a very particular and very complex form of derivative. The credit rating agencies tended to leave the agencies and the banks and the lending institutions rated with high ratings because when you issue a credit default swap, there's a guarantee on those mortgages which also have a government guarantee. So you have double guaranteed mortgages, and the credit rating agencies therefore tended to regard the securitized instruments as having high value. So the credit rating agencies also got sucked into the overrating and over-securitization and overconfidence in the mortgage market. Federal Reserve policy, foreign borrowing, and search for yield. Everyone in the 90s and in the early part of this decade was looking for a relatively high yield. The Federal Reserve policy was to keep the Federal Reserve Board, the Treasury, and the various federal agencies out of this growing derivatives market because these instruments were making money for the banks that were supporting them and underwriting them, and because it was an entirely new kind of transaction that the Fed believed, especially under Mr. Greenspan, would grow faster and more coherently and more economically without being warped by regulation. Foreign borrowing, there were countries, particularly China, which were acquiring large amounts of US dollars because of the trade deficit. This foreign capital was rattling around in the foreign markets, and they wanted a piece of the pie and a way of making a little extra money for themselves. Also, this was particularly true of the large German banks. And the search for yield. If you're a bank, you want to borrow money at a low rate and then loan it out at a higher rate. You can get an extra bit of return if derivatives are involved.